Good morning, everyone. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here on the next 40 minutes here on Options Guy TV. So, what a week. Markets still seem to be resilient. We did get a little bit of a pop up in the VIX. The VIX index right now is still staying at 1928 is where the VIX is at right now. It's down just a smidge today. We got the S&P 500 index up about 1%, trading at $6,708. I do want to get just short the S&P 500 index. The volatility skew is definitely leaning towards the downside, and long put spreads are fairly cheap, fairly inexpensive relative to where the market is at, considering what is going on. So, I wouldn't want to buy a put outright because you're paying up for a lot of volatility, but I don't mind looking at an SPY long put spread this week. So if you went through the scenario, and I don't know, is there anybody out there that actually did the full trades? We introduced time spreads heading into earnings on the one stock in particular that I've been bullish on is Goldman Sachs, and we had the big downturn in the market once after the 100% tariff announcement last Friday. And so if you had sold some calls, a lot of those calls expired worthless. But as I mentioned, and I've been bullish on this for quite some time, the deal-making stocks have done very well, including Wells Fargo. So I think Wells Fargo in general mentioned that their investment banking side was up about 25% in the revenues last quarter. That really reflected on Goldman Sachs. Also had the same type of comments in JP Morgan. All of those stocks did very strong after their earnings announcement. You also saw Citigroup have a strong quarter. That stock was up quite a bit. And I really think that's what's holding the marketplace up right now. You have gold setting another new record high. So 4,000, thought maybe it would pause a little bit, was thinking about doing a butterfly on the show around the 4,000 level. And I don't know if I would have leaned bullish or bearish. To be blunt, not 100% sure, but the stock gold prices just didn't stop, and so GLD didn't stop. And gold right now is right around $4,200 an ounce, and then we see oil 4,209 is where gold is at right now. Russell 2000 index is up. That one got beaten up a little bit worse on Friday than anything else, which usually has a tendency to happen on bad news. Still want to stay long financials. We still have we still have quite a few financial companies that are going to be announcing earnings coming up here. And I guess, like with Goldman, I don't even mind buying a deep in the money call. And I think there's a little bit of safe haven by being in the financials. Now, if the Fed does lower interest rates and they don't have any data, as a matter of fact, I wrote down today the data that I wrote down Monday morning, the data they're not going to get. They're not going to get retail sales. They're not going to get jobless claims. They're not going to get hourly earnings, all because of the government shutdown. And they have to make a decision without any of this data on if they should raise or lower interest rates. So hopefully the Congress opens up the wallet, I guess is the word that I was looking for, and starts funding some of these things so we can get things back in line. I don't really quite my only argument can be that the financial companies were so strong this week that is a big reason why the market is up at this point in time. So let's run to the Tradier Pro software. And if you are long a call in Goldman, if you are long that position, I would close it out today. The way that it all played out, you would just be long the call option We never did close the actual spread. We might have been able to roll it one week, but that was the week that I was gone, that I was traveling. So you were on your own to do it. But normally you should be. If you're doing any of these trades, be prepared to adjust the trades if you would like. So do it whenever you have to. But the Goldman Sachs trade did very well. And like I've mentioned more than once, I have quite a bit of Goldman in my account. Just long stock, not to mention to go along with the option contracts. So UNH, it's filling the gap again. So the chart is interesting. 362.47 on UNH. Let me see if I can get the chart up. So here's the gap that we've been focusing on. And we still got a little bit of room to run, right? So we're at 362. We can't, I find it interesting when it does this, especially when we talk about it we talked about it the whole way up, all the way through that gap. Is it went, look where my cursor is. If I put my crosshairs right on the bottom of that, we touched the very tippy top of that gap. Then the government shut down. And UNH became a focus of that government shutdown, mainly because one of the biggest reasons for the shutdown is the Affordable Care Act. And is the Congress willing to continue to fund the Affordable Care Act going forward? And because of that got interpreted as bad news for healthcare companies. So I guess you could say if they do fund it, if they do come to a resolution on it, that could be good news, right? So not a bad time. Maybe this is an opportunity to go into United Healthcare and actually do another trade. I don't. Do you recall exactly? I think we did a long call spread on United Healthcare. Let me go and look where that would be. Does anybody have a position on? And good morning to you, Kurt. Go ahead and toss that one out there. Let's get the ball rolling here. Appreciate it. I appreciate any comments in the chat box. Talk amongst yourselves. No worries. I always like to make this as interactive a show as possible. So on UNH, we bought the 355 and sold the 370. October 24th expiration. Paid a little bit for that. $6.57 is what my screen grab is showing. So let's go in and look at the 355, 370. 355, 370, and we have the October 24th expiration. 355, 370. So we are up $1.20 on that trade. We put it on for my screenshot says 650, but the market was 628 when I looked at that. So 770 is the price right now. 773. Obviously stay the course. You see the momentum. It was also a play on the fact that if the government does open up, you do think that the healthcare could happen. And every time we come back on the chart, every time we go into we bump up against a resistance to the upside. The next time around, there's more and more chance that it will actually go through. It's hard for the resistance to hold 2, 3, 4 times. Eventually, it usually will make its way above, and then we're going. I guess 200-day moving average would probably be the next stopping point, right around 385. And then if we get our ducks in a row, we see that all of the 20-day, the stock is looking healthy as far as the chart is concerned. Now, it's a little bit, in my mind, too big to fail. Once again, I mentioned the Warren Buffett scenario where they came in about $1.6 billion over the last couple of quarters. So with all that said, there you go. Did you put that trade on, Kurt? Go ahead and throw those out there. Thank you for the comments on it. SPX. And then in the SPX, looking at the October 17th expiration, we have open wing butterfly. That was the UNH. I think this is the trade that we did also. Let me check this out. And now I want to get bearish in the SPX. So this was on the 13th. We did a open wing butterfly to the upside in the SPX. And that's the 616, 6625, and 6630. So let's look at the SPX. And we're leaning on the put side of things. We're going to go out to the 10/17 expiration. We got 2 days away on this. 6/15. Oh, wow. $6.25. 6/15 buy. 6/25 sell. Oh, and IWM, were you able to get Kurt to go ahead and put those in? Toss them both out there. So did you do okay on the IWM trade, Kurt? Did you get out on that Friday when the market went down? Because IWM has bounced back just like the rest of the market. Kind of curious. And then 10/17, we're looking at the 630s. Let's go and sell that one. Oops, we'll buy that one. Oh, I'll take that price. $94? Sure. I don't think that's right, though. Oh, we got two of them. Okay. That makes sense. 470. Okay, so we put this initial trade on for $3.40. Able to close this one for $4. Well, it's 470 right now, but it's looking strong. So with this scenario, with the market at 6,700, right? We are close to the max. So let's say you paid $320 for it, and it's worth $5. So you're looking at 180 is the maximum you can make on it. That means that this would be trading for $5, and it's fairly close to that. Let me send this to the what if calculator. So it's almost trading for the $5, but with the market the way it is, here's a great example of the open wing butterfly and the difference between this and a standard butterfly, or even a long call spread, if you will, in that you'd be there's no benefit to wait on a long call spread. You put the long call spread on, you pay more for it. The maximum exists if it goes above the high strike. So in this instance, we would have been a 10-point wide long call spread. We turn it into a skip strike or an open wing butterfly. We lower the cost. The market is now up here. I actually so far up that I can't see it. But if the market comes back by the Friday expiration and it lands in this area, well, you're going to do better, right? So there's no rush to get out unless you need to get to the golf course, or got some holiday shopping that you need to do. Then I suggest just selling it. I would put it in at about 4, and I don't think 430 is even close. I'd put it in at 490, maybe 485. See if we can fill at those prices. Paid $3.20 for it, $3.20. Market comes back this way and closes within this expiration. Then we could make an extra $1 or $2. Maximum it could trade for would be $10. So I like that one. Didn't get out on Friday. Okay, so IWM is still in. I think we're going to the end of October. Let's look at the chart in IWM. And on the VIX, was it the skip strike, I'm assuming? I'm just talking with Kurt now. I apologize if anybody else is out there listening, I guess. So IWM is back up above. So here was the the downturn, and now we're here. Yeah, I don't like where this is at. Because that's a solid breakout right there. Now you could have, I guess you could have, we talked about a long straddle, but the long straddle would be hurting a little bit too. Long straddle, you would have definitely wanted to get out on the put side on the downturn and then let the call side ride. But yeah, so right in here, so we had the noise right around the recent high, and now we're pretty much established that we're at a higher point on this. So I don't like where IWM is at. I do believe that I would go to weekend. I think there's going to be a lot of news that's going to come out over the weekend, and I'm going to lean bearish in the market. I don't quite understand why this is being taken so well in the month of October, everything that's going on at this point in time. But and I've sat and struggled with that, and a lot, I think, analysts just in general have, and I really do think that the AI money that is coming into the marketplace is acting as a stimulus to the market, almost like when the government just gave people money back in the COVID days, where that type of income and that type of spend from big corporations is what's propping up the market and just not letting it fail. And I don't see the end to that. I don't see the end to that. So I was expecting, I actually have some cash on the sidelines, to be blunt, in retirement accounts, where I was actually looking for a downturn. Maybe I'm whining right now because I was looking at a downturn to be able to, insert some capital into the marketplace. And I particularly was targeting this month. And then we ended up with the news and the government shutdown and the tariff talks again and all this other thing. And the market just is resilient across the board. The tech stocks are battling a little bit, but obviously I want to lean into financials. Also want to lean into utilities, which we talked about. Actually, I don't know if I talked about it on this show, but last week, utilities were I think I mentioned it. Utilities were the only sector. God, why am I struggling with words? Is the only sector that was up besides consumer staples. So utilities actually had, the data center play had, a very good week and a down week in the marketplace. So that's XLU. And XLU is just not a bad play if you want to if you like to trade ETFs, just buying them outright. XLU, I wouldn't mind getting along that position. Okay, so my trade today, I am going to lean into this weekend, and I'm going to look at the SPY. I know it's Wednesday, it's not Friday, but I want to look at the SPY today. I looked at the skew in implied volatility, for example. So I'm going to go out to October. Let's go to, actually might even go a little bit further. Just cause September to the end of October. October 28th is here. November 7th is 23 days away. 31st. Let's go. It's between the 30th and the 31st and the 7th. All right. We've done a lot of trades with the 31st. So let's keep that expiration there. Okay. We're going to go a little bit into money. We're going to go about the October 30th SPY. Vols are around 19. We're only paying about 15 for this. This one isn't bad, but this is what I'm talking about in the skew. So let me highlight this column. If you bought it at the money, you're paying 15 vol. If you go down to the 655 strike, for example, you're receiving, because you'd be selling that option, 18 vol. So that, on a $668 index, fairly expensive options. And then that translates to, this is $8 and that's $5, right? Like they're you're receiving a lot because of the nervousness and the people that are rushing to the markets to buy puts as protection. And so it's showing up. So if you're doing a put spread, you're going to be able to get it done for a fairly decent price. And you're taking advantage of the fact that a lot of people are buying those out of the money options. Now, that's normally the case. I don't want to make like this is some big anomaly. In the SPX and the SPY, normally you see out of the money puts trade at a lot higher volatilities than out of the money calls. But this at this point in time, this is a little bit higher than normal. And so we're going to take advantage of it. Just like when we wanted to do our bullish VIX, no, our bullish SPX open wing butterfly. If the vols are high, we're looking to trade on our normal butterfly. We're looking at paying about around $3 for it. And if vols are low, back in the 15, 14 range and on the VIX and accordingly, then you're looking to pay $4 or even more, almost $1 to $1.25 more per butterfly with the exact same setup. So vols definitely matter in the indexes. They matter across the board. But I really feel it especially if you're trading 0 DTE options. SPY. Let's set up the trade. Okay, so let's go 670. Let's make it easy. And then we're going to I want some room to the downside because I want this option contract to be able to expire. So it's not that I'm necessarily targeting a 50-point move. I just want, as time decays, we got to buy this back. So I would ideally like to buy the 670s and see it go down to 660 or 655. And then this option contract just kind of wither away because it's not quite getting to that strike. And that's the ultimate goal. If it blows through it, that's fine. Not a big deal, but that's part of the rationale. I'm not necessarily targeting a price with this bear put spread, but this is what we're going to do on it. Okay. Let's remove it. Buy this. And we're going to go down and sell the 650. All right, so 525. So a little bit more expensive than I try to do on this show. Usually I try to keep it around $300, $400. But we do got some time. We have 16 days. And I do consider this a speculative trade. If you think that this market can sustain, the government, here's the thing. If the government shutdown stops, that's going to be a catalyst to drive the markets higher. So if you think that that's going to happen over the weekend, right? If you think that we're not going to go past 21 days, and every week that goes by, things stop getting funded, and that always happens. But if we go to the end of the weekend and the government opens up, obviously this is going to be a bad trade. So that's your risk. That's your risk. I like it because of the risk reward here. So we can basically, what I'm trying to say is that the 670 put is cheap because we can sell this. We're selling 20 vol and we're buying 15 vol, right? 1541 is the vol. So we're getting this done for half price. All right. So let's send that to the what if calculator. Does everybody kind of understand that? And it is the nervousness. So there is still a lot of uncertainty. The one thing that is happening or isn't happening is that the VIX isn't going back to the 15 level, even though we're setting new highs. We just saw IWM break out to the upside. So on that trade, Kurt, if you're still in it, I would probably look to get out. I kind of want to wait the weekend to see the news. But the chart says that we should get out. So we should probably get out because if we do break out to the upside, if the tariff news and all this doesn't happen, the chart says that we didn't bounce off of the resistance and go down. Yeah, very good risk reward on the vertical. Yeah, I agree with that. So 230, 245. So we're looking at, okay, so the width of the spread is 20 points wide. Okay. Let's call it 525. 525. So if we look at 525 divided by 20, we're almost triple, right? Well, it's five. We'll say call it $5. It's triple. So you're putting in a play. You're got $5, and you got the potential to sell it for 20. You got the potential to triple your money on that trade, going 20 points wide. And once again, I'm not targeting the 650. What I'm saying is that's $5 that's in there. I'm more than happy to just let that decay and not quite get to that range. Because also, if we go down, we will see implied volatility go up. So the at the money put, or the put that we're buying, will increase in an implied volatility, and that will help it. And then the time decay, we're far enough out of the money that it will erode on the 650 strike. So also, if I do this trade, my adjustment, let's say we went out to the 31st, right? 16 days away. Okay. So there's also a potential for adjustment. In other words, this market goes down, and let's pretend that we're kind of correct on our forecast, and the market trails off and goes down to 662, right? But it takes a week to do that. We see a little bit difference in vol. This starts withering away. We can buy this back and hopefully pay $1 for it and roll that up to maybe the 660 strike or the 655 strike and bring in an extra $1 or $2 to help pay for this trade. So by going further out of the money, letting that option contract expire or wither away, buy that back and then roll it up. And that's one of the advantages of being way out of the money on this call option, that you do have an adjustment. And with any trade that I'm usually doing, even 45-day trades, to be blunt, I very rarely adjust more than once, because I do think that eventually got to give up. And you do have bid-ask spreads in options, much more so than you do in stocks. You're still paying commissions at a lot of places, unless you're trading through Tradier, right? And there's different deals where you can do a lot of trade. There's a lot of stuff that Tradier has done that's been inventive as far as commissions are concerned. And so if you're looking at these trades and you do over adjust too much, you can give away a lot of your gains through bid-ask spreads and commissions, right? So, and costs, I'll say, just that way. So I like to adjust one time, and especially on a 16-day trade. So that's my trade. That's it. We are at time. Any other questions? But you can easily see, I think it's very apparent to me that I'm looking at, I would move this, I'd move it a little closer, but that's fine. Let's keep it right here. 980. 420. Gosh, you're 40 points below this, and you're getting half of this value. Obviously, the skew has a lot to do with that. All right, everyone, that's it for this edition of Options Guide TV. I will be back on Friday. I do got a little bit of travel next week, but I will be back on Friday, and we'll look at how this trade is doing. And don't be afraid to get out of it. Like I said, my nervousness is that the government opens up and the market, takes a big leap of faith after that moment. But in the short term, there are a lot of things to be nervous about. And for some reason, the market is ignoring it. See you this Wednesday. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.